How do actuaries determine your insurance premiums? Imagine trying to guess how much money you might need to cover future expenses. Actuaries do something similar when they set your insurance premiums. They analyze lots of data to figure out how much it might cost to pay future claims. Their goal is to set a price that covers these costs, the company's expenses, and still makes a profit. They also want the premiums to be fair and affordable for everyone. The process begins with collecting data from the past. They look at claims made by people with similar profiles, like drivers or homeowners. They study how often claims happen and how much they cost. For example, in auto insurance, they examine accident rates and repair costs for cars like yours. If you drive a safe car in a low-crime area, your risk might be lower, and your premium could be less. Actuaries use different models to make these predictions. One model looks at the total claims from a group of policies to estimate overall risk. Another model assesses risk for each person individually. In life insurance, they might use special models to predict death rates based on age, health, and lifestyle. These models help determine how much to charge each person. They also consider factors that influence risk. Age, gender, health, driving history, location, and the type of coverage all matter. For example, a young driver with a clean record in a safe neighborhood might pay less than someone with a history of accidents in a high-crime area. These factors help insurers tailor premiums to each person's specific risk level. The premium includes several parts. First is the risk cost, which is the average amount expected to be paid out in claims. Then there are fixed costs like administrative expenses. Variable costs change depending on how many claims or policies there are. The insurer also adds a profit margin to stay financially healthy. Sometimes discounts or adjustments are made for safety features, loyalty, or other reasons. Actuaries use advanced statistical tools to combine all these elements. They update their models regularly with new data to keep premiums fair and accurate. This ongoing process helps reflected changes in risk patterns over time. Understanding how premiums are set can help you make smarter choices. If you know that your risk factors influence your rate, you might take steps to improve them. For example, maintaining a good driving record or installing safety features can lower your premium. Shopping around and asking about discounts can also help you find better rates. Knowing that premiums are based on real data and careful analysis can make you feel more confident about your insurance decisions. It shows that fair pricing is possible when insurers use facts and solid methods. This knowledge supports community and financial empowerment by helping you plan your budget better and make informed choices about your coverage.